And while we're still letting other people, get the message that this is going on, I'd like to ask, did you happen to look at this podcast that I found yesterday about the sports gambling business? So
No, did you send it to me?
I didn't send it. I think I just sent a Substack note about it. That this was sort of it was something I couldn't react to as a libertarian in any in a libertarian way. So the podcaster is this guy, Aaron Wrenn, Renn,
Hmm.
and he is a evangelical intellectual. Now, if you grew up the way I grew up, those words don't seem to go together, right? I mean, if there
Sure.
were Chat GPT that was based on only on conversations among Jews, and and these chatbots have to predict the next word, and you said so and so is an evangelical, the next word it would never predict intellectual. But in fact, Aaron Wrenn is an intellectual. He's a self-described evangelical, and he has a great podcast. And the one I caught, he had this guest talking about the sports gambling industry. And the guest's name, it's a South Asian name. The first name is Cigar, only it's not spelled cigar. It's spelled Sagaar, or maybe it's the other way around, Saagar. Anyway, uh, I watched about half of it. It's only about 40 minutes long. And by that time, I was convinced that the sports gambling industry is they're just master scumbags. Like
Yeah.
their mission in life is to find really vulnerable but somewhat affluent people. That is the sort of people who can't control their gambling once they start, and just separate them from their money. Um,
I
and
mean, I think so. The Tzvi also, I think, had a post on this a while back. Maybe it started with Scott Alexander. I think there was some research that tried to quantify. It was, I think they set it up as an event study, right? Because every state decides when to legalize gambling, so you can actually like build a reasonable time series. And I don't remember the exact data, but it was to the effect, created non insubstantial like increases in like personal bankruptcy. Um, it was actually kind of interesting because like you could see auto defaults, mortgage, things. The only industry that actually did okay was the credit card industry, because the credit card industry is so quick at cutting bad spenders off. They get sort of the inverse adverse sample problem. So like when the gambling comes, their credit performance actually improves, mostly because they've cut off the degenerate gamblers.
yeah, well, it's
But
too late for the guy who made the auto loan a year ago or the mortgage loan
exactly,
two
or the
years ago.
mortgage. Yeah. I mean, I don't know. I think I probably, was become more, I think, probably from your influence, become more sympathetic to sort of cultural conservative inclinations over the years, and things like traditional vice, like gambling and, drugs, or, prostitution. It's like, oh, maybe, maybe they were onto something in keeping the
Yeah.
whole concept of haram and contraband. Maybe there was some wisdom behind it.
So
I,
yeah,
yeah.
yeah, this was really shocking to me because I came at this at least fantasy baseball so innocently. Back in the late 1980s, less than 10 years after the rotisserie baseball was invented, I joined a league, and this was with a bunch of guys who background mostly economics, finance, people like us. And we were so cheap. The tradition in rotisserie baseball was is that each owner would put $260 into the pot, that they would bid on players with a budget of $260. We divided that by 10. So it was $26 a piece.
Over your
And
entry
these
fee. Yeah.
so these are very high salaried people. There was one guy who was one year who was earning over $1 million a year. So we're just doing it for the sheer competition, and I'm going to show you. And boys getting together in somebody's basement, and so once a year you have the auction that you can go with in this fantasy thing, and after an hour after it's supposed to start, the last guy would show up, and then you spend an hour talking about the rules and the procedures, because when you get a bunch of boys together, they really got to get the procedures and the rules straight. And by a few hours later, the room is filled with body odor and pizza smell and beer breath. Just a bunch of guys, very competitive, getting together. It was very innocent. And now, I guess since 2018, when gambling was sort of legalized, gambling was sort of permitted by a court decision, Supreme Court decision, something like that. And now 40 states have legalized it, and there's this industry. So anyway,
Yeah.
that's weird stuff. All right, I think we've let enough people come into to the chat. Do you want to?
I will. So yes, but I will say one final coda on. Well, actually, well, two things. One is it's funny because fantasy sports was in some ways my anti-establishment radicalization moment early on, is when in the late 90s or the early aughts they were basically nerds with spreadsheets on the internet who were better at roster construction than the extremely highly paid general managers who did this professionally. It was just kind of an interesting phenomenon to observe. Then to begin to think through like how that came to be. Why was it that people like Fangraphs and the other sort of, even if it was before Bill, going back further, Bill James, but that was sort of before my time. But like why were they why were they so much better at the
Yeah.
business of baseball and than the people who were ostensibly experts. It's sort of that was a beginning of a journey, I would say.
Well,
But
it's a great moment for nerds, right? Because you're
yeah,
quite the data nerd, and I'll tell you
yeah.
I'll tell you a story though. Bill James, maybe before your time, but he was not the first baseball nerd. The first baseball nerd was Earnshaw Cook, who in 1964 came out with a book called Percentage Baseball. But he doesn't have computers or anything. He's doing all this by hand. So there's no following at all. Also, he had no charisma. He's probably the kind of guy who walked around with a pocket protector all day. But yeah, no, Bill James got that whole analytics thing going. Anyway,
Yeah. There's also
so
about cartels and why they could maintain this old boys club, and that's make them resistant to train and begin to think about institutional, like why when MLB was sort of became recursive, or they all of them
yeah,
self-replicating, is really interesting. But also on the gambling, just switching for a second, is like I guess the counterpoint is to say, I mean, I don't know, I don't really know the economics of like credit cards and ATM cards and all of that, but my general understanding is like it's an extremely useful free product and service to the vast majority of people who use it, that it largely paid for by the small percentage of people who use it poorly. And I guess could you make the same
right.
argument around this sort of sports gambling stuff, which is like for most people it's just fun. Like I'm not a big gambler, but like I like Vegas every now and again, but I set a limit. I don't have any problem cutting myself off, and I find that that's sort of fun.
Yeah, I think that's
um,
true for 95% of the people who do it. But you're right; they
yeah.
make the money off the other 5%. And if the credit card industry is the same way, that's then they're kind of that I have to put them in the scumbag, master scumbag category.
Yeah,
Um,
but you don't want to do away with credit cards, I don't think.
no,
Yeah,
uh,
yeah.
so. All right, so you've brought up this topic, and other people, commenters on my website, have brought up the topic of this Warren Buffett article uh, on import certificates. You want to can you explain that one for us before I tell you why I don't like it?
Sure, I will do my best. I'll say like the context here is, I'm sort of preternaturally, contrarian in the sense when everybody starts freaking out about a thing, even if I necessarily am sort of, I'm sympathetic with it, I have this tendency to sort of go back the other way. And when the tariff stuff, there was just so much a collective freak out. My inclination was begin to try to make the steelman case to the extent that I could. And in the course of those journeys, I don't remember where I found it, probably on Twitter or something. There's this 2000 November 10, 2003, Fortune article or op-ed from Warren Buffett, where the title is "America's Growing Trade Deficit is Selling the Nation Out from Under Us. Here's a way to fix the problem, and we need to do it now." And the basic gist of it, it sounds very. At that point, the trade deficit was much smaller, so the actual deficit was much smaller. But the basic sort of narrative setup that Buffett says is like, look, again, just speaking in Buffett's terms, that by we're sort of trade, we're by selling the trade deficit capitalizes the rest of the world to invest in us, but we're essentially, giving a call, giving the rest of the world a call option on America, and that's a bad thing. And the way to fix it, I thought was actually kind of clever, is he proposes these almost like carbon credits, but they're trade deficit credits, so that every time there was the U.S. did an export, that would create credits, tradable import credits that foreign importers could then use and trade, for on a one-to-one basis to then import into the U.S. And so that way, I don't know if that was clear enough, but basically, the way to balance the trade deficit would be is that for every export would create this import credit, and then every importer to the U.S. would have to have one of these import credits of a matching amount, to do their imports. But these things could be freely traded, so that if you are, you know, I don't know, the idea would be is like it should create some, rather than arbitrarily penalizing certain deficits, which make a lot of sense. It would allow the market, I guess, to sort of decide where these credits ought to go. Is that
Fair.
a
So
fair?
that's, yeah, then that sounds, the analogy with the carbon credit is right. And there are a lot of economists who like the carbon credit idea. I think and it is, and in today's context, you wouldn't have Donald Trump waking up every day with a different story, which would generate a lot better certainty in the markets if you had something like this. Um, and, it does have the seeming virtue of guaranteeing trade balance, balance in that in trade. And of course, what as a conventional economist, I would say is, well, our trade deficit is offset by this capital surplus, which is, in Buffett's view, and that's actually what Buffett is worried about when you say they're getting a call option on America. That capital surplus means uh, foreign saving is higher than our saving, and they're taking their saving and they're taking our securities, mostly treasury securities. Somebody has pointed out that even though we have sort of this capital deficit, in that sense, the investments that we own overseas earn such a higher return compared to the stupid treasury bills that the foreigners buy, that we actually do pretty well in that aspect of it. But the point I want to make really is that if we're going to get rid of our quote capital account surplus, which and another way to put it is get rid of our savings deficit, then we either have to save more or invest less. So, most economists think of it as starting from the capital account. Like, suppose we reduced our government budget deficit, then we would, as a country, be saving more. Or suppose we did something to, stimulate savings, then we would save more. And that would be, that would start from the capital account and then work its way back to the trade account. If we save more, would lower our trade deficit. So Buffett's proposal, I think, would work that the other way around. You would lower the trade deficit, and then that would kind of force a um, a change in savings, so that we don't, so that somehow we end up saving more. And unfortunately, I think the way that would play out, unless the government cooperated by lowering the government deficit, is that we'd get a lot of less domestic investment. And that's why that would be my sort of mainstream economic argument against that. But it's really an argument against the whole concept of trying to fight the trade deficit directly, rather than curing our lack of saving, and the biggest role that the government plays in that is by running these more than $1 trillion deficits every year.
Yeah. No, I agree. Obviously, whether I agree, you know more about this than I do, but that the prime mover is clearly our fiscal deficit, not the trade deficit. But I guess like just to try to devil's advocate for a moment, I suppose like, well, I mean, I think part of Buffett's point, I suppose, is like it's not, we consume things, but we are in exchange, we're giving up ownership, and there's something qualitatively different between okay, or short termist in some ways. Okay, we're buying cheap goods now, but we're giving away ownership, and something that Buffett almost understands in his bones is like you want to own. That's the seat you want
Yeah,
to be in, right? That's you don't want to be in a consumption. You want to own the rights to the to the equity, so to speak, and own the rights to the future cash flows. That's the so I think intuitively that I can't quite put my finger on it, but something seems right
yeah,
about that, right?
yeah, and if it does, if these import certificates, I mean, if it would work out, that would it would raise the price of imported goods, which would mean that people would, hopefully save more because it would raise the cost of spending and stuff. Um,
The other thing
so
I get. Oh, sorry. Go ahead.
yeah, no, go ahead.
No, I guess the other thing I suppose is like if you sort of think in Trump's terms, is like it seems like what he wants is. I mean, the other alternative is not just save more or invest less, is to get other people, the other rest of the world to buy more or invest more, right? To save less and buy more. That would be the other, like that's the alternative to tariff is, either build your factory here, so that's sort of investing here, and obviously, this is, I don't know if Charles is listening in, but that would show up as foreign direct investment worse than the surplus, but presumably like the GDP that it would kick off domestically would not. Um, but so that I guess that's the other thing too is like, but you could balance it out by just buying more of our or buying more of our things or lending us more cheaply, like they were talking about the 100-year, the long duration, low interest. I mean, that would be a neat fix, I suppose. Like,
Yeah,
right?
yeah,
Uh,
but
I guess
yeah, no, that's true. What if you're lowering the foreign saving rate, then that creates the offset in the capital account. Um, so I had another topic which I teased in my on my Substack today of investing from a standpoint of paranoia.
well, so
Uh,
I do want to get to that, but just while we're on, I just actually like it occurred to me to ask a question to you, and sort of thinking about like what would a Liberation Day victory look like? Let's say like what would it look like to say actually we got it wrong. It turns out Liberation Day was right, and what would that look like? Do you think like what would be the evidence to say this worked out somehow?
yeah, well, that's a good question because for most Trump haters there wouldn't be any evidence, but it should, you know the fact that he's in office just guarantee, it's an existential failure on his part. That he
Yeah.
exists means it fails. Um, so um, for it to succeed, I would say, um, I guess a full-on success would be that uh, the manufacturing share of output in the United States rises, that the investment share of spending doesn't fall. I mean, I don't think I have to go so far as to say it rises, but that it doesn't fall. Um, so those would be the things that I'd be looking for because, in the end, the trade deficit's just a number, the capital surplus is just a number. Um,
But
But
what about
it
just like revenues and
seems like the goal, the alleged goal is to revive the manufacturing sector. If the manufacturing sector stays about where it is or continues, well, it'll certainly continue to decline as a share of employment, probably decline as a share of measured output, although, comparing the output of a factory to the output of a hospital is always problematic. So we don't, it's hard to do that. But I guess by some measure, maybe, our manufacturing sector relative to the world, if presumably that's been falling just because the rest of the world's improving. If that falls by less, that's a victory. And again, but I would focus on the most is domestic investment, because that's threatened sort of macroeconomically just by the mechanics of reducing the trade deficit. And it's also threatened, if you look at things like the stock market and it's just the general attitude of corporate America to uncertainty, that
Yeah.
also
Well,
threatens investment.
uncertainty, surely, though, in theory, like if we land on some kind of settled rate, then the uncertainty goes away, and then it's just a question of dealing with the tax. I guess another way too would be, can't you just, there's the revenue net of dead weight. I guess it's hard to measure the dead weight cost, but in theory, if it raises more revenue than it costs in terms of like overall productivity, is that a win?
Yeah, and I think the odds of that are so low that I didn't even mention it.
Yeah. Okay. Yeah. I actually wonder about this too, though. Like, why do you think? Like, I totally, I get that why there's going to be a pass through to consumers, but you would think, and I think there's some of that actually already happening. Walmart, whatever. Like the bigger retailers, like why can't they pass more costs onto the suppliers? Like why are they not price makers rather than price takers? And why is everybody so sure that they're going to be price takers?
Um, I'm not sure. No, yeah, I don't know, where the relative, competitiveness of the markets lies. So, yeah.
Yeah, I don't know. It's just I don't know. I get this inclination. I guess the other sort of thing that occurred to me, and then we can move on, is like, is there some you know in the beginning where we started with gambling, professional gambling, the companies are they're the bad guys, and they're just trying to separate the fool from his money. Is does that analogy transfer at all? Like, yeah, sure, the deficit is our fault, but is the rest of the world taking advantage of us in that way? Are they separating us like a fool from our money? By selling us cheap things that we can't really afford? Does that
Um,
analogy transfer?
I'm not too happy with it just because I think, in the gambling case, there's only a small fraction of people that you target. Here, it's all of us. I know, I don't think I'm sort of stupid for you know holding this phone that has lots of components made in China. You know.
Yeah. No, it's fair. I don't know.
I
I'm
mean,
just
on the other hand,
spitballing.
If China's listening in to, like, personal calls and
Maybe we are. Yeah.
maybe I'm being
Yeah. I
stupid.
mean, the problem is, I guess, it's a bit of a daisy chain, right? Because like the stuff that we finance unsustainably is like healthcare consumption. But presumably, if we had to pay for our healthcare ourselves, we would have less money left over to buy iPhones from China or something like that, right?
Yeah,
Um, so maybe it would impose some, if we didn't have so many fun other things to do with our money, it would impose some cost discipline or something. Seems
yeah.
speculative, maybe.
Well, yeah. Um, I mean, since so much of our excess spending on healthcare, I think, is due to all the way the government subsidizes it, and government seems to not resist any kinds of discipline. I guess the way that the foreigners are responsible is they're buying all those treasury bills and bonds.
Mhm.
But that, so okay, that could be a fool's story that that.
Yeah, I think that's the analogy. Is just like, on the one hand, you could say, look at our investment or capital surplus, and the great advantage we have is we get all these cheap lenders. But then I guess the inverse is right. This cheap lenders is a is short termist, and is running us off the cliff somehow, and they're
Yeah,
doing it on purpose.
yeah,
Um, yeah, it's not perfect, but I'm trying. I'm trying.
yeah. Right, there you go.
um, anyway, yeah, paranoid. I like this paranoia. Actually didn't know what you were referring to, but why don't you go back to that?
Okay, so Um, I'll stick with my fantasy baseball analogies. So this year, for the first time, I'd been hearing about, for years, the NFBC, National Fantasy Baseball Championship, rankings of players. Like you just, there were this guy was number 100 last week. He's moved up to 72 this week, and so I'd heard all about it, and I was having trouble entering a Yahoo league in part because part of the time I was in a state that bans gambling, right? So I couldn't I couldn't even log in. I mean, I couldn't even sign up for a paid league. Anyway, so I go to this NFBC, and immediately I become paranoid because I get this sense that, oh, the stakes are really high. I'm getting all these pop ups and suggestions to join leagues, and I became very paranoid. And so I think that kind of attitude, from the point of view, if you were investing, would be to say, somebody's out to get me. There are master scumbags out there, and the government is either too incompetent or corrupt to protect me, and I have to walk in with that attitude. And I'll just say one area where I have that attitude, and this is another area where they'll throw my libertarian card out and tear it up, is on Bitcoin. I just see, like, the latest thing is these companies that are, publicly traded companies, that their assets consist of Bitcoin, and their market value is a multiple of book value. And it's that, as Matt Levine points out, that's like a perpetual motion machine. If I can raise, $1 billion, buy $1 billion of Bitcoin, and have my market cap go up by 2 billion, well, then I can go back and raise more. And as
Do
I'm
it
doing
forever.
that, I'm buying Bitcoin, and Bitcoin goes up. And anyway, so I just I have that kind of paranoid attitude. Now, I guess I shouldn't have that kind of paranoid attitude about equities. I don't think that there's master scumbags, you know, buying the Nvidia, but I'm not convinced that the people buying Nvidia are doing it necessarily on the basis of rational calculation, even if maybe a rational calculation is even possible for something like that. So anyway, uh, so act as if they're out to get you, and then I'm not sure what to do with that. Right? I mean, it's if everyone's out to get me. Uh,
I mean, I think yeah, I don't. I mean, I'm not a trader. I've never been to the extent I do much investing, it's mostly like the long short, fundamental stuff. I'm not actively in and out of names. Um, but my understanding of a lot of the way people do describe, like, your work at Jane Street, that there is a kind of sense of, there is a zero sum element to it where it is constant game theory, and um, people are, there's somebody out there that's trying to rip your face off, as the expression goes, and sometimes you get them, sometimes they get you, and but I guess even backing up, right, in theory, like, right, that's just like the rational market, but like, no trade should ever clear, right? I mean, why should somebody want to pay more than somebody's willing to sell it for? Isn't somebody getting taken, like, somebody losing in that scenario? Like, again, like, the answer is no, right? Because there are other factors at play. There's duration, there's time preferences, there are liquidity needs, there may be some other opportunity for me to, take it, use that cash and use it for something else. Um, right? I mean, it's sort of an odd. It's odd for you to take. It's not the paranoia is an odd position for you to take, especially in the context of trade, because, like, you could extend that sort of negative sum thinking to all transactions, right? Like, why is it specific
why is it
to
specific
just,
to finance? Because
yeah?
that's a good question, and I think partly because I think there are some people who are so much more informed and scientific about it. Like I'm an old guy. I have a lot of history. Um, the savings and loan crisis, Wall Street and Freddie Mac and Fannie Mae just looted the savings and loan industry. They were just so much smarter, and they would walk in. Mike Milken walks in and says, "Oh, these junk bonds, these are really good, and you can finance these shopping centers. It'll be really good." And the people, and the typical savings and loan executive is some guy who, just he got his charter from the government, from being, pals with the uh, state Senate majority leader or whatever. He doesn't know anything about the math, and uh, they just don't know what they're getting into. So there is a portion of the Wall Street investment banks, taking that kind of money from people, and maybe there's some of that going on in the sort of the day trading world with like daily options and stuff. I can't imagine
For
that
sure.
the typical person who's buying trading daily options really knows as much as the people who are creating the market in those options.
Yeah, I mean, and again, to go back to the finish, the initial setup of this the stinking body odor room full of dudes doing dude things. Like I constantly come across people telling me that they bought this stock or they bought that stock, and I'm thinking to myself like, you know, you could do that. We all do it. I do it too. But like, there are hedge funds, are sitting there, we're much better at this, putting a lot of more resources into it. Like and the easy things that you're going to lose, right? Or at least it's just it's basic. Might as well flip a coin, right? There's no information advantage that you're going to have over them, um, that would allow you to sort of eat the market, so to speak. But I don't know. Like I guess the other part of it is maybe they don't either. Maybe they've just kind of like convinced themselves that they that they that they have so that they can foresee the future better than they can. But it's sort of like you know I don't know, like drops. It's all drops in the ocean. Maybe I don't. It's a
Yeah,
little vague, but
it
yeah,
is it is better than the slot machine because overall, over long periods of time, it's a positive sum game because there are positive returns to capital. So it is a positive sum game. In that sense, you can hope that as you invest long term, you shouldn't be paranoid. I guess the the feeling that I've had just over the last couple of years is that the stocks overall have gotten ahead of themselves. And then my other big concern is what to do about inflation and the possibility that I worry about of very rapid inflation. I just sort of scan the possible investments that deal with that, and none of them really satisfies me.
so even so, on inflation, get to this, but on the investing point, I say the one striking thing to me, at least, I mean, there's more than one that I've seen. Like, sort of when you deal with professional investors and hedge funds and all of that, whether not even just publics, also privates, is like how much of individual investor careers can come down to one or two trades. Like they may make one great trade early, and then for the rest of their lives, they're geniuses, even though the results don't necessarily show it. And it's just amazing how that dynamic plays out, and how arbitrary it can be. Like, it's like taking a baseball player and be like, well, if they got a hit in their first at bat, then they're great forever. When we know sequencing can be kind of arbitrary. So there's definitely a lot of that. Yeah, and I talk about VC, like again, these are asset classes that I like, but you could, one VC is or real estate, right? These are industries that have made, or private equity. They've made tons and tons of money over the last 15 years, which, for the benefit of hindsight, seems to be primarily driven by extremely low interest rates and just an increasingly large money supply. So, like, these are we were, and again, like, don't hate the player at the game. Obviously, the game is available to everybody, and they played it better than other people. But a lot of the ways in which we regard these sort of titans of capital and these brilliant financiers is like, "Oh, it's not that brilliant." I mean, I'm oversimplifying, but I do think about that often enough, is how many of these little path dependencies of and how much like survivorship bias is out there too. Is like, you see the investors who sort of, or entrepreneurs. You read a business book and you read about some CEO who did X, Y, and Z, and it's like, okay, great, this must be the way to do it. But it's like,
Mhm.
what about all the CEOs that did the same thing and failed? We don't read
Yeah.
about them as much.
Yeah, a little bit of
Um,
survivorship bias there. So so what do you think is the probability that of sort of the everything bubble? That is that a scenario? What weight do you give that scenario?
I don't know how to, you know, how to, I don't know how to put a probability around it. I mean, I think it is clearly true that at this point, like that asset prices, um, clearly, the market is right. The marks are too damn high. Like that's sort of, I don't know if people, if that's a New York specific thing, but there was this mayoral candidate from probably about 15, 20 years ago who was kind of a hilarious figure. And he just would say the rent is too damn high. And he wore gloves and a
Yeah,
hat.
right. Yeah.
And he was quite the character. But, you know, I'm sort of, yeah, I think that everybody is still priced to an interest rate regime that does not appear to be coming back anytime soon, and would be very surprising if it did. Now,
So
does
your
that mean,
your example, classic example there is housing, where people have the option to hold on and not mark to market. So your story of
and
housing,
private equity too? Yeah,
yeah, okay, is for those is that okay? So you bought this house with a when mortgage rates are 3 or 4%. It's now for somebody who is facing an 8% mortgage, they can only pay, two-thirds of the price of what you paid for it, but you don't feel like selling it. And so you just kind of extend and pretend to yourself, so to speak. That's,
well, you have a 30-year mortgage. You shifted all of that interest rate risk. The banks are
yeah,
locked in. They're locked in, but you're not.
yeah,
You get to take and the contrast is like if you look at the commercial real estate market where same basic dynamic in terms of supply and demand. The only big difference is that their rates reset, whatever they negotiate. Some of them are floating, some of them are 5 years, some of them are 3 year. But when those rates reset, they either have to divest the asset, often for a loss. We've seen that, or figure out how to increase income, or something. But like the market moves,
yeah,
and it hasn't gone up and to the right. Quite the opposite. Yeah, I think, and it's the same thing in private equity and private capital general. VC is a much smaller subset of private equity, but like for this is the Cliff Asness line. There's a volatility, or illiquidity premium, which doesn't really make sense. Normally, you would think illiquidity would cause a discount, right? Because it's better to be liquid. But it's like, oh, there's a premium to being illiquid, and the stand of the story has been because managers, they don't have to respond to the ebbs and flows of the stock market. They don't have to mark them. They can be opportunistic when they buy and sell, and ultimately that leads to better returns. And there's some truth to that, but I guess the flip side of it is it also allows you to sort of keep your head in the sand for longer and ignore volatility that is obviously there, but you're just choosing not to realize it. And I think that's certainly true in private capital markets. Where the bid ask is just still way too wide, and I think I think there is there are professional people who do mark these assets and there are rules around it. So I don't want to be too glib. Like there is, but they can vary a good deal. And either way, the evidence is pretty strong that, like, certainly in venture, but to some extent private equity, is whatever they think the bids are, the asks aren't, or whatever they think the ask is, the bids aren't meeting it, right? Like we just know that
yeah,
transactions aren't clearing. So, whether there'll be what exactly everybody is waiting for, and it's a moving target for a while. It's always, well, the IPO markets have to open back up, or blah blah blah. It's like, but
yeah,
how? Why? Like, what? Why would that happen? Other than magical pixie dust. And again, some of it, I actually remember having these conversations back in 2021 with some VC people. It was just like when inflation was running away, it's just like, look, interest rates are going to go up, and your business is going to grind to a halt. And they're just kind of like, well, I never paid attention to macro before, so I'm not going to start now. And I think that there is. Yeah, and this actually comes back to, yeah, I think that still predominates. And there's also, like, some of it is like stuff that you read about, all the sort of specialization in trade and the hyper specialization is like people do within these individual asset classes. They become extremely specialized. They stick to their knitting. They know what they know. They don't, other things feel like a bit of a distraction, even if they're more connected than they like to admit. And I think that, I guess, the flip side of that specialization is that sometimes there's this kind of magical thinking of just like, well, yeah, eventually conditions will turn. Eventually rates will go back down to zero or something, and then it'll all be fine. It'll be back to normal. And it's like, well, hey, that wasn't that normal to begin with, um, but that was very much a post financial crisis phenomenon of like very low interest
yeah,
rates. And it's not clear that, yeah, but to go back to the original question, how much, like, what are the probability of an everything bubble? I think the answer is there's almost 100% probability that there's some element of an everything bubble, because it's just so hard not to look at the credit creation an asset price appreciation, starting 2010 after the financial crisis, and just see those things go up hand in hand, and like how much of our growth, asset price appreciation, is related to just taking on a lot more debt, probably more than we should have. But how painful the come down has to be, I don't know. I think that's, again, like, I did, I've gone from very bearish to less bearish, just at a certain point being like, I've been, impressed by how resilient and adaptable all the various market participants have been, and maybe that shouldn't be a surprise. But they've just, whether it's private companies getting lean very quickly, lenders increasing their covenant, like the parade of defaults, the parade of horribles just hasn't happened. Like, people have lost money, and certainly in real estate they've lost money, and other asset classes too. And I think there are other shoes to drop, but that happens sometimes. But it hasn't been an apocalypse.
Yeah.
Um,
All right. Can we come back to this maybe to another other one? I've got a pretty
sure.
hard stop coming up. This has been fun, and this whole issue of, I mean, I could see a discussion of the sort of private capital and public capital relationship. I don't. Do you get Matt Levine's newsletter? Yeah.
I do
So,
read Matt Levine. Yeah.
and he's been on top of that. That's just a very interesting development. So there's a lot of cool stuff we can talk about, but
Well, there's this great line that I lifted from the people at the FT Alphaville people. The in the private markets, no one can hear you scream. It is. It's like the very stable marks that they tend to have. Um, but yeah, no, this is super. I guess. So, do you have to leave? You have a hard stop now? Because I
yeah.
wanted to ask you. Oh, that's too bad. I wanted to
Okay.
ask you about the '60s. Um, I wanted to shift back to the cultural transition of the '60s, which you've written a little bit about recently.
Okay. We'll save
Um,
that for next time.
all right.
Sounds good. All right.
Okay.
Great talking to you. Good job.
Fantastic. All right. Talk later. Thanks,
Okay.
everybody. Wow, 76 people. Not
Okay.
bad. Okay. All
All right.
right. Bye.
Sure. Bye.